Hey, good morning, everybody. It's Hammer. Today is Monday, September 8th, 2025. I, of course, am here with the daily mortgage rate update. Welcome back. It's going to be a busy week, my friends. Hopefully, y'all had a fantastic weekend. Let me know in the comments if you did. And if you didn't, well, I'm sorry. Don't bring the rest of us down, though. No, I'm just kidding. If you really didn't, I really am sorry. I hope you all had a great weekend. I had a great weekend, even though my friends with the hot air balloon never actually got to take it up for a ride. The weather conditions this year at this rally here in North Dakota, not very conducive to flying, very windy, and then no wind, and then very windy. Unfortunately, it's just the way it works out for them sometimes, but still always great to hang out with friends. So it was awesome and had a good time. In fact, I am still in North Dakota, but I'm in Bismarck this morning where I will be hopping a plane to go to DFW to finally get home sometime tonight. And then I'll be back at my desk tomorrow. So anyway, that's what's going on in my world. Hope you all are doing well. Remember, you can join me live each and every weekday morning, 9:30 a.m. Eastern time. Even when I am out of the office, I'm always here for you. So we will, of course, be here. If you're here this morning, say good morning. If you're watching on the replay, don't forget, just give me a hashtag replay in the comments. Let me know that you were here. If you would like a quick reminder that I'm going live, we send out a text message each morning as we're getting ready to push the button. You can go ahead and sign up for that. QR code is right down here and you can also go to hmmr.io/reminder. hmmr.io/reminder. While I'm showing you some stuff, if you'd like, you can also sign up for free email lock advice. That's at ratelockadvice.com. I send out an email each and every weekday morning with lock advice. You're welcome to use it any way you want. You're welcome to share it and claim credit for it. Do whatever you want. I don't care. People do that already anyway. You can go ahead and use this QR code if you'd like to sign up for that. And that's ratelockadvice.com. We also have our text alerts at ratetextalerts.com. Those are paid. They're $7 a month, dirt cheap, but they keep you, kind of level in this crazy market that we're in. It's actually not so crazy right now. It's very calm, but still good to have. So anyway, go check all those out. They are there for you. Let's go ahead and say hi to all the live folks, and then we will jump in and get into the good stuff. We've got a lot to cover today. In fact, talking about what we do have to cover today, I'll throw it up there. Where is my happy? Here it is. All right. So today we will be talking about more news on the BLS jobs front. We have the annual revision. So I'll talk about that. The inflation data coming in this week. We've got both wholesale and consumer inflation, and we'll look back on what happened with last month's wholesale inflation data, the PPI. And then the last one is how far can momentum drive down rates? We'll be talking about that. How far can momentum drive down rates? Of course, momentum on our side right now. So that's what we will be talking about this morning. Let's say hi to all the folks here this morning, though, real quick. We'll breeze through. If I miss you, I'm sorry. First one to say hello is Leroy Romero. Happy Monday, sir. Mallory Fotiadis. Good morning, Monica Dinkins and Mike Brown, Deb Dickinson. Great to have you. Sean Segaloff. Your Facebook team and all three fantasy teams lost, but football is back. There you go. That's positive. Michael Love, good morning. Amy Blaser, Randy Tico. Giddy up, sir. Mike Tebow, great to have you here. Angela Walters, Holly Johnson, Bill Stevens. Thank you, Randy, for the safe travels shout out. Ron Siegel, good morning. He says National Dog Walker Appreciation Day. Today is National Dog Walker Appreciation Day, so appreciate your dog walker. Amber Moser, good morning. Mike Morano, good to see you. Harmony Edwards, good morning. Well, thank you, Randy. Appreciate you. I missed you too. I was only out on Thursday, though. I did come in for Friday. Megan Bissell, good morning. Tiffany Teal, Matt Rasner, Alison Foy, Will Patterson, Sean Leland, Almer Cryptic. Good morning, all. All right. So again, today we're going to be talking about what's going on with the BLS jobs data. inflation data coming in next week and momentum. Let's go ahead and let's start off with the technicals, though. Let's go ahead and take a look at the technicals. Let me share my screen and I'll show you what we've got going on this morning. And we'll kind of recap along the way what happened on Friday and why things are so good. So, taking a look here, if we go ahead to the technicals, what you'll see here, let me open up Presentify real quick. All right, so should be this one. Yes. All right. Boom. So if you take a look, mortgage-backed securities currently up 13 basis points on the day. However, 13 basis points is a lot when you look that it's on top of right here, which was Friday's jobs data. So we had a lot going on. In fact, if we go ahead and push this back a year, can we get to those September? Our best levels here were 101.53, 101.61, 101.57. So I think 101.61, if I'm reading that correctly, the red's a little harder for me to see with my eyes. 101.61. So those were our best levels last year. You could see right here. This was right before the Fed rate cut. And then after the Fed rate cut, things really got just plummeted and went terrible. I don't think we have to worry about seeing that again this time around because I think that markets will expect that the economy and jobs are continuing to slow a little bit, but we're not going to necessarily see it take off to the moon. But we are seeing some of the best rates we've seen, and the door is getting very close to open for more consumers to take action. So we'll talk about that a little bit more as well. Let me refresh the page because it won't slide over. In fact, let me see if I can zoom in and if it'll, there it is, good. So take a look at the 10-year treasury yield. Look how nice and low that is. Remember, we want a low treasury yield. It's the opposite of mortgage-backed pricing. We want the 10-year to drop. So 4.05, and we can see what a difference that is and how much lower we are, right here than we've been in months. So going back June, July, August, we've got this level here. And Thursday last week we broke it, and Friday we smashed it, and this morning it's continuing to drop a little bit. So this is a big deal, and it forecasts very well for us. And in fact, let's go ahead and put this into a year and take a look at 10-year treasury yields. The last time, again, coming off of the September area down here, you could see back in September of last year, we were still, look at how much lower that 10-year treasury yield was. It was in the 3.6s. And right now we're still above 4 right here, as you can see, right? So, and you can see it visually on the chart here that even though we are down, we're basically, these are we're very close to the best levels we saw in March. And then in March, we did see a big spike up. I don't think we're going to see that, but I don't think we'll necessarily see it just continue to drop. But look at those September lows. Look at where this 10-year treasury yield was here. Now, mortgage rates, you'll notice, are still very similar to where they were back in September of last year. These are very close to the lowest rates that we saw even back then. If we go ahead and go to this chart, and let's get rid of some of the noise, and we'll just do the 30-year fixed. So let's go a little bit further. Okay. So you could see that, we were right here was what, 6.11, 6.12, even right here, 6.20. You could see where we're at right now. See how low we are? And we're almost coming down to these lowest levels. Even though that 10-year treasury yield, there was a huge difference in the 10-year treasury. And that shows you the spreads between mortgage-backed securities and the 10-year have gotten a lot slimmer. Mortgage rates are much better than we are seeing in the past with a similar 10-year treasury yield. So before, when the treasury was around 4, we were higher. Rates are lower. Again, mortgage-backed securities and the spread between the mortgage bonds and the 10-year is slimmed down, and that's a good thing. So we don't need to understand it all and dig too deep into it. It's just why you're seeing what you're seeing and why we're seeing rates that are better than what we saw in the past on an equivalent 10-year treasury yield, and why we could see rates continue to drop lower from here and why that door is open. Now, of course, what pushed all of this was the weak it was the weak jobs data on Friday. So BLS jobs data came in. They wanted 75,000 jobs. 22,000 jobs were created. Unemployment ticked up to 4.3%. Participation rate was, I think, a tick lower. So all of this, why we're seeing such a strong reaction, and we'll take a look at Fed futures. Basically, markets now pricing in Fed rate cuts and where they'll go. Let's take a look, see what your comments are. Ron Siegel said a low 10-year is good for us, not for our seniors who live off fixed income. Always two sides of the coin. Yeah, no, exactly. And anything that brings mortgage rates down is generally not going to be great for the economy or the labor market. So it's not really good in that market, in that realm either. Randy said, if I buy a bond at levels today, what happens if the levels change tomorrow, up or down? Randy, when you're buying a bond today, what happens, and I think you're throwing me a softball. I think you know this. I think you're just helping me put this out there. And if you don't know it, that's perfectly, great too. But thank you for that either way. So when you buy, let's say that you're buying a mortgage-backed security, when we see this at 101.24, what that really means is, let's say that we are buying a stack of mortgage-backed securities, and a mortgage-backed security is selling for $100 for one bond, right? Let's say that this is what we're at, right? So, and that bond, right? So this is one bond, and it's $100 face value, and it's a 5.5 coupon. So oversimplification, because it doesn't work exactly like this, but close enough. We'll say that this bond is giving us a 5.5% interest rate. Now, I could put my money in a savings account right now, probably make about 3.5%. I could buy a mortgage-backed security at 5.5% to get a 5.5% return, and it's going to cost me $100 to get a $100 bond, except it doesn't. There's what's called a premium. The premium is the money over $100. So because 5.5 is a better interest than I could get on other, say, my savings account or other safe investments, then I'm paying a premium to buy that $100 bond, which actually drives my yield lower. I'm making less money on it over time. So that's why when we look at one bond, it's a premium, you're paying more. And it could be 101, 102. And if we look at different bonds, as that bond pays more interest, like the 6.0, that premium is going to be higher. You're going to pay more money to get a bond that's giving you more interest because you're getting more interest. So you're going to pay a higher premium up front. I'm paying $102.54 to get a $100 face value bond. And when it cashes out, when it matures later, I'm only going to get $100 back, even though I spent $102.54 on it. But that's going to allow me to get 6% interest over the life of the bond. So I'm getting more money over time, and that's why I'm paying a higher premium. And if we look lower, we can actually, it's not always a premium. Sometimes you will pay to get that bond. So you're not paying a premium, but you're receiving a discount. So this one, because I'm getting less interest, I'm getting a bit of a discount. I get a $100 face value bond, and it only costs me $99.70. It's below value because I'm getting a lower interest. Now, what happens is the interest paid and the price of these bonds fluctuates depending on what's going on in the bigger world, in the full realm of the economy, especially how much interest you could be getting by investing elsewhere and the safety of that. Now, of course, investing in, say, something like stocks, where you have the least amount of guarantee and the least amount of safety, you're going to have the opportunity for a higher rate of return. But something fixed like this is going to be right around there. 10-year treasury yields have the full backing of the government. So a 10-year treasury, the yield on that is smaller than what you would get on other investments, because it's a guaranteed payback unless the U.S. were to default on their debt, and that's considered to be basically the surest thing out there. So that's what we got going on there. Let me go ahead and stop sharing. Nathan said it's much less complicated. Rates are better today because you locked yesterday when you saw the 10-year creep back to 4.10. Isn't that always the case? Somebody's got to fall on the sword, Nathan. Bill Stevens, consumer debt is at record level. And we've talked about this. There's definitely a consumer bubble. So, but we could talk more. It's 4 or 14 minutes. I don't want to go too far down that path. But the cash out refis, like, so that's the key. Yeah, Bill's pointing out to, and that's the answer. Consumer debt's a record level. Consumer debt excluding mortgage debt is 5.4 trillion, and as rates fall down and people can buy their way into the fives with points, that's going to open the door. People, the fives are going to look very, very attractive to people. They've forgotten about the twos and the threes. You know, you've got your handful of people that are death gripping, but overall, people are, the fives are the magic number. So we're getting very close to that. Let's go over and talk about what I said we would talk about a little bit and go over some things. So I said we're going to talk about news on the BLS jobs data front. So tomorrow, on Tuesday, we get the annual revision, which runs through March of 2025. Okay, so just like every month, they go back the last 2 months and revise the jobs numbers, number of jobs created, and all of that. They then do an annual revision. Now, I'm going to show you an article about that and show you some scary things about what's going on there, and also something interesting. But before I do, I wrote this all up, so let me go ahead and at least put it on here. So, quick recap: we've already talked about it. Rate sheets on Friday, or bonds on Friday. They saw big reaction to the BLS jobs data. Data came in showing confirmed labor market weakness. Like I said, 22,000 jobs created, a very small number, much smaller even though than the 75,000 that was expected. Rate sheets should be the best we've seen in about a year, since last September. We should be seeing rates very close to that level. We took a look at that. It was around 6 1/8. We're around 6 1/4. So, but you know, we probably will come all the way down to those levels. Rate sheets are still improving. Bonds are off to a good start this morning. We're up, 13 basis points or so. Rate sheets should be the best we've seen in about a year. Reprice risk on the day is low. Momentum is not ready to shift against us yet. So the momentum from that jobs data, and traders basically, I'll show the screen for a minute. Traders basically betting on the fact that yes, we're going to see. Hold on, we'll get it there. That we're going to see Fed rate cuts, and as Mike Morano and Ron Siegel are thinking, traders have moved in a little bit of a direction, about a 12% expectation that we could see a half a point cut in September. It's really going to depend on this week's inflation numbers. We're going to get the wholesale inflation on Wednesday. We're going to get consumer inflation on Thursday, and that's going to make a big difference. But right now, a Fed rate cut is totally priced in. But the possibility that that Fed rate cut could be a half a point, this is a 50 basis point cut, that's actually there. And if we see this grow, if we see this column go higher, you'll see pricing that can improve on that kind of news. So keep that in mind, and that's kind of where we're at. So, but reprice today is low. It's no reason we're going to expect anything to turn around at this point. So, but taking a look at, let's go back to the things that we were, that I said we were going to talk about today. More news on that BLS jobs data front. Let's see. Eric said, sad that 97,000 Fed workers had to be dropped for this massively forced unemployment. It's an artificial market adjuster. Eric, it's much bigger than that, though. You got AI that's really starting to have an effect. I mean, I go to mastermind and business functions, and people are talking about trying to like the people that I hang out with, they want to use AI to make their people more productive, but bigger corporations are going to be looking to cut people. And that's what you're seeing some of that as well. Mike said, I've heard comments 150,000 people die or retire each month. You also have your business's birth date model, Mike, that goes along with that. And that 150,000 jobs means a net zero. I don't know anything about that. I've never heard that myself, so I don't know. I've never done any research on that. Ron Siegel said, triple on that softball. You had to give a long explanation. Otherwise, it would have been a home run. Sorry. All right. So anyway, let's go ahead and let's go to what we're talking about here. Let me show you. So BLS jobs data, inflation, and everything else. So first, let's take a look at the jobs data. So today is tomorrow rather is the day that we will get the markdown for the BLS. So once a year, they go through March of this current year. So from March of 2024 to March of 2025, and they're going to go through and they're going to adjust the the figures that have already been released and then adjusted. So these are numbers from the past, and we could see that in the past, in 2015 it was adjusted minus another 208,000. 2016 you got 150,000, right? So the jobs number for the year was adjusted lower. I wish they had the total numbers that were reported so we could compare what percentage that is. In 2017, it was actually adjusted higher, more jobs created. 2018, slightly higher, more jobs created. And then 2019, it gets to be a much bigger number, 500,001 jobs that were basically removed from the numbers. 173,000 in 2020, 166 in 2021, which this one is surprising to me. But then what's really surprising, 2022, this one is because of all of the COVID situation. So expecting a big shift then kind of makes sense because we had a reason why we would have seen revisions and why numbers were hard, but it was a 462,000 job creation. So this is positive in that scheme of things. 23 was 306 to the negative. Again, pretty sizable number, but last year's number was absolutely outrageous at minus 818,000 jobs that were basically pulled out of the numbers of what we said jobs were created. And the expectation is that we're going to see another huge number. All right. So the expectations right now, like economists at Wells and Comerica and Pantheon and blah, 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 they're saying that we could see almost an 800,000, another repeat of what we saw last year. All right, of about 800,000 less than currently estimated. That's what they're expecting to see. Markets are expecting to see a big, big move. What this will also do is this will open the door for Trump to say that that all the data that was coming in the past was wrong and that he inherited a much weaker economy and a much weaker labor market, and that he'll find a way to spin it that he's making it better. Instead of the fact that we've seen that it's continued to have gotten worse. So you're going to see a lot of spin around this, especially with Trump. Trump's ego definitely will get in there, but this is going to allow him to blame Biden and Biden's administration for the current economic condition and the labor market condition, and to say he inherited this problem and he's turning it around. So but that number, that's going to continue. The relevance to us in the mortgage world is that's going to continue to open the door for Fed rate cuts. Expectation, again, I don't think that we'll necessarily see things move in a direction that give enough for a half point cut this September, but the idea that we'll see some longer cuts. Now, that's going to be tomorrow, so that's going to come up and be a bit of a big deal. Not something that we have to worry about or that you have to protect ourselves from, but we'll see I think that's going to actually help rates improve. And let me throw the lock advice by there up here, so that we want to keep floating. There's no reason to lock anything right now. So we're going to go ahead and keep floating and see where this goes. Tomorrow, there shouldn't be any threat of that. Wednesday, we have the producer price index. Now, let's remember last month, I'll get this right. I haven't had any coffee yet, y'all. No joke. Last month, the producer price index, normally not a market mover, that scared everybody when it came in so large, basically pointing to the tariffs starting to trickle down through into the consumer sector, and consumer inflation would be next. And so if you remember, PPI inflation shock, core producer prices hit a 3-year high in July, and head scratching inflation surge. I think that we're going to see more of an emphasis on this month's producer price index than usual because of how poorly the data went last month. So we're going to be watching this one for sure, but that's on Wednesday. And then Thursday we have the big dog, the CPI, the consumer price index, and the consumer inflation. So there's a lot on that. And on Friday, we got consumer sentiment and some other stuff. But this week, if inflation, depending on the reaction, if inflation is not as high as people are expecting, especially with talk that the tariffs may be reversed in the courts and things like that, I don't think it's going to derail this week's momentum, and I think we're in a good position to go ahead and keep floating everything. Even loans closing near term, I don't normally we would be more concerned if we get some rumblings as we go into Wednesday and Thursday's data. That'll then we'll pay attention to that and maybe consider locking some near term loans if they're still out there floating. But right now, it looks like we could see rates continue to improve. So we're in a good spot on this stuff, y'all. It's definitely not a bad place to be, and that's it. So hope that gives you guys some heads up. Again, thank you for the softball, Mr. Teagle. He said, what would it take to get quantitative easing? It would take a lot more. Quantitative easing, the Fed really, really would want to avoid that because that is inflationary. And quantitative easing would, of course, be the best for mortgage rates. We've talked about before, because quantitative easing, if the Fed chooses to buy mortgage-backed securities, it has a much more direct effect on mortgage rates and pricing than we would see when the Fed is moving the Fed funds rate. What would it take? It's going to take some really, really weak economic data and talk of recession. We would have to see a heavy risk of recession, and that's not currently on the table. So we've got a few Fed cuts coming up, and we'll see where that goes, but I don't think we have anything for that. Sean said Scott Bessent over the weekend sounded the alarm. If SCOTUS rules against tariffs, they may have to pay back half the tariffs. Why half? What a weird thing. Think that will affect the bond market? Yeah, absolutely. If something like that happens, it'll shake everybody up all across the board. So how it will affect it and what we see, I don't know for sure. We'll find out. So, but I don't want to over prepare for that until we get there, and I don't know that we can, because it's uncharted water. So, what do you think, Sean? What do you think will happen? Mike Tebow, you've heard comments that so we already talked about that. All right, cool. So, I think we hit everything, y'all. I'm going to wrap it up, and I will be traveling today, but I will see you probably dog tired in the morning, but I'll see you in the morning, and we'll see, kind of what happens. And let me see, what time does those job data, what time does that adjustment come in? I think it comes in before the show. So I think we'll be talking about that tomorrow. Hold on, I'm looking at the economic calendar. It comes out at 10, actually. So we won't have the numbers at 10. I mean, we won't have the numbers on the show, but I don't know. I'm going long now. Maybe we will, right? So I keep getting longer and longer. So, but you guys are here. Well, thank you for joining me. I'll see y'all tomorrow. Have a fantastic day. Take care, everybody. Bye-bye. Thank you, Monica.